Welcome to RBC's Markets in Motion podcast, recorded July 29th, 2024. I'm Lori Calvasina, head of U.S. Equity Strategy at RBC Capital Markets. Please listen to the end of this podcast for important disclaimers. 3 big things you need to know. First, earnings season has been fine so far, and what we've read has kept us in the tired Goldilocks camp. Second, we run through the latest updates for the indicators we're monitoring in the rotation trade. We are mindful of head fakes, but think the trade may still have room to run in the short term. We also still think whether a durable multi-year leadership transition is underway remains to be seen. And third, individual investor sentiment took a big hit last week per the AAII survey, while U.S. equity flows have remained strong, keeping us on guard for a potential end to the current pullback. If you'd like to hear more, here's another 6 minutes. Now let's jump into the details. Takeaway number 1. Earnings season has been fine so far on the stats. Our reading has kept us in the tired Goldilocks camp. On the stats, the good news is that 79% of companies in the S&P are beating consensus on earnings. The bad news is that only 58% are beating on sales. This has been a trend of late, but the gap has widened. It's also worth noting bottom-up consensus earnings forecasts are holding steady for the S&P 500, 244 for 2024 and 278.50 for 2025. We simply haven't seen much change to these since the start of reporting season. The key themes in 2Q earnings call transcripts are still emerging, but overall what we're reading is keeping us in the tired Goldilocks camp. Companies have been highlighting a strong and stable backdrop and resilient consumers despite pressures from higher rates and inflation. Labor and cost pressures remain in focus. Commentary on international markets has been mixed. The Fed has been in focus, particularly the pressures emanating from higher rates. Uncertainty associated with the U.S. election has been a bigger discussion point than the past. Moving on to takeaway number 2. The rotation trade may still have some room to run, though we're mindful of head fakes as some of our indicators are back to levels where the trade stalled out at last time. Also, whether this is a durable leadership transition remains to be seen. Here's a rundown on what we're watching on the rotation trade right now. First, we've been watching earnings sentiment upward revision trends for a shift that would support further rotation in market leadership short term. Unfortunately, we just haven't seen it yet. Despite the challenging news flow from the first few mega-cap growth names that reported, the rate of upward earnings estimate revisions for those top 10 names in the S&P remains much, much higher than the rest of the index. Separately, the Russell 2000 remains at parity with the S&P 500 on upward revisions, an improvement from 2023 when this stat favored the S&P 500, but we've not seen a clear shift in favor of small cap yet. The second thing we're watching is consensus expectations. Quite simply, different segments of the equity market are at very different places in their earnings cycles. Mag 7 names saw net income growth contract in 2022 and a surge into recovery in 2023, with decelerating growth rates embedded for 24-25. Meanwhile, Russell 2000 net income growth contracted last year and is expected to move into recovery in 24 with a major ramp in 25. The S&P 500 ex Mag 7 cycle is more similar to small cap, but with a milder recovery. Consensus forecasts are looking for the strongest net income growth in the next year and a half from small caps. For the moment, Mag 7 net income growth is still expected to exceed the S&P ex Mag 7 very, very slightly. On both of the earnings stats we're monitoring, the case for a leadership shift from large to small seems a bit stronger to us than the case for rotation within large. The third thing we're watching is positioning. It started to move but has more room to go for mega cap growth and small cap. CFTC positioning data for NASDAQ 100 futures has started to slip from levels in line with February's peak, but the decline has been pretty modest so far. We've seen more of a shift in Russell 2000 futures positioning. It's getting close, but isn't quite back to early 2024's peak. The fourth thing we're watching is valuation. Not too much change here recently. The top 10 S&P 500 names are still trading at a median forward PE of 30 times, a ceiling they've had trouble breaking through, while the rest of the S&P 500 remains at a median PE of 17 times, a bit above average but well below prior peaks. Meanwhile, the Russell 2000 weighted median forward PE continues to sit at historical averages, a level that served as a ceiling after the big move up in November and December of last year. Overall, we see valuations as a reason for the rotation trade within large cap to keep going. On the small cap side, valuations seem to be neither a headwind nor a tailwind. And the fifth thing we're watching is flows. In recent week, equity funds flow data has been highlighting a shift away from growth and tech, alongside a shift into value, small cap, industrials, materials, commodities, and financials. There were some hints of stabilization in growth and tech flows in last week's update, along with a little slippage in value, financials, and materials that we'll be keeping an eye on. Bottom line flows have been a tailwind for rotation, but we are monitoring them for signs of a stall. All of what we just went through speaks to shorter-term tactical issues. Whether or not we're at the start of a durable multi-year shift in leadership is a whole other question that we're still debating. We've highlighted in recent weeks that a sluggish, below-average economic backdrop is more supportive of growth and large-cap leadership than value and small-cap leadership. In last week's investor meetings, another concern came onto our radar. Our rates team expects a short and shallow Fed cutting cycle similar to 1995 due to the resilience of the U.S. economy. The problem here for small caps is that Fed cuts usually only tend to serve as longer-term springboards for a new small cap leadership cycle when they occur alongside recessions. In 1995, when no recession occurred, there was a rate cutting cycle that only benefited small caps for a very short time. Let's wrap up with takeaway number 3. Individual investor sentiment took a hit last week while U.S. equity flows remained strong. This all keeps us on guard for an end to the pullback. The current pullback in the S&P 500 has been about 4.7% from recent highs. Not quite as bad as the April pullback, but it is getting close. We've gotten some relief on our sentiment work. AAII net bulls fell to 11.5% as of the 25th of July, taking its 4-week average to 21%. This stat is no longer more than one standard deviation above the long-term average on the 4-week average, as was the case in the prior update. This is good news for U.S. equities, as stocks often stumble after hitting that one standard deviation mark on the 4-week average. We'll be keeping a close eye on this data in coming weeks to see if optimism gets extended again or remains subdued. Politics are also a challenge. The S&P 500 has generally continued to track expectations Trump will win the White House in betting markets. Trump showed some signs of stabilization in certain betting markets and averages towards the end of last week. But zooming out, Trump's lead in betting markets has generally been narrowing. Interestingly, polling on the generic congressional ballot also tightened up over the weekend. We see the election as a source of uncertainty for the U.S. equity market in coming months that could deepen the pullback, but note that pullbacks in presidential election years are quite normal. That's all for now. Thanks for listening, and be sure to reach out to your RBC representative with any questions.
This content is based on information available at the time it was recorded and is for informational purposes only. It is not an offer to buy or sell or a solicitation, and no recommendations are implied. It is outside the scope of this communication to consider whether it is suitable for you and your financial objectives.